Okay, good morning, everyone, and welcome back to our market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. Now, we have a lot to cover here this morning. The markets are about to open up significantly higher than we were closed yesterday, back at 286. So let's go over the research as far as what we see. Now, before we get started, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes, and it should not be considered as a recommendation or advice to buy or sell any specific securities. Now, let's start by taking a look at the current market outlook. We've been talking about 285, 284 as a major resistance level for quite some time now. The market sold off very heavily during the coronavirus sell-off, rallied back up to that 284 level. This 284 level has really been a bit of a battleground area for quite a few weeks now. Ever since the first test of it, it got rejected, tested again, got rejected, finally broke out above, and then broke back below, and now we're back above it. So 284, 285, this is a very large area of control. There's a lot of shares being traded around this area. As of right now, markets have found a bit of an equilibrium. There is quite a bit of, you guys can't see my screen? That's odd. Sorry, one second. Okay. Sorry about that. Apologize. So as I was saying before, markets where we currently are, we sold off heavily during the coronavirus sell-off. We've rebounded very quickly within a couple of weeks of that initial 220, 218 low back into the 284 area. We've kind of been very congested in this 284 area. We've tested it multiple times, many times trying to break through but failing, eventually breaking above it, but then broke back below it last week, and now we're trading right back above it. So you have a lot of shares and a lot of congestion here in this 284, 280, 290 zone, if you will. And right now, there's quite a bit of, I would say, difference between the weekly chart. The weekly chart rallied up to some major resistance levels and really had trouble breaking into those resistance levels. Last week, we had that major distribution bar on the SPY. I think this week we're going to try to make a run back into that resistance level again. The daily chart has consistently found support throughout this 20-day exponential moving average. Bounced off it yesterday. Looks like it's about to open up above that 285 level. So at this point, everything that we're looking at is predominantly fairly short term, basically sell the rallies, buy the dips, sell the rallies, buy the dips. That's kind of been the market environment that we're in. It reminds us very much of the December to February rally during that time when the Fed pumped a lot of liquidity into the markets. We basically saw this kind of sell the rallies, buy the dips, sell the rallies, buy the dips. We're kind of in that same environment at the moment. The thing about positioning during this type of time is that you have to be fairly nimble. You generally have to get in and out of longs and shorts fairly quickly. And the downside to this type of trading environment is that when you do get a pullback, they tend to be fairly violent. So today we're going to look at some of the research to show you what we're currently looking at and give you a sense for the different sectors, because I think when you look at the individual sectors and you see the bifurcation in terms of strength across the sectors, it makes a little sense as far as why you see the markets are currently in this kind of battleground, up a couple of percentage points, down a couple of percentage points, not really having true momentum in one direction or another, and really just moving relatively sideways as opposed to with any strong directional move. So we've had this battleground in this 284, 285 support or resistance area. There are clear signs of exhaustion for this market, and I'll go back to the chart in 1 second to show you what those signs of exhaustions are. But, something we've been talking about for weeks is that as markets continue to move higher, momentum hasn't really continued to move much higher. Momentum has actually predominantly been sideways. These are the types of exhaustion signs that we typically see. If you look at the weekly chart throughout this entire rally, money flow has actually remained negative this whole time. This is usually a sign that this type of rally cannot be sustained. But that doesn't mean that the markets can't continue to move higher to, let's say 302 before it starts to sort of roll over. And if we do get that, you really get I would say from a chart perspective, a fairly nice head and shoulders pattern, if you will, if the markets get back here and then starts to roll over. So you kind of get this little bit of head and shoulders pattern here. At this point, the market really needs to get above this weekly resistance to retest 302. So let's take a look at some of the individual sectors and some of the other research that we're currently looking at. Now, we've been talking about the VIX for quite a few weeks now, and the VIX has really been flip-flopping back and forth between what we would consider risk on and risk off. So front month VIX, which is the 1 month standard VIX, is trading at 34, 3 month VIX trading at 37. That's normal. That's what we call contagion. So this is what we consider a risk on environment. If the front month VIX was higher than the 3 month VIX, that would be considered a risk off environment. And the VIX has really been flip-flopping back and forth between risk on, risk off, as the market kind of trades a little bit above that 284 level, trades a little bit below that 284 level. So it keeps flirting with this risk on, risk off metric. But at the moment, it clearly stands on risk on, but usually this doesn't last necessarily for many days. If we look at US COVID-19 trends, there are some things that we need to pay attention to here. One of the things that I want to point out for the COVID-19 trends is really the difference that we're currently seeing between New York and the rest of the country, because New York has really been the epicenter of the coronavirus. But recently, over the last few weeks, we've noticed a clear acceleration across the rest of the country, whereas opposed to New York is seeing a substantial decline in cases. So we're going to show you some of that research. And also we want to take a look at some of the charts that tell us a little bit more about industrial demand. And I think that speaks to sometimes the true impact of all of this for industrial demand, for the global economy, if you will. But I think there's a bit of dislocation in terms of the overall markets and where some of the industrial metals and industrial commodities are currently trading. And then what we'll do is we'll go through all the different sectors. We haven't taken a look at all the sectors in a while, so let's take a look at each individual one. So we'll start off by talking about the coronavirus trends. So we've been talking about this for weeks, and I stopped looking at the coronavirus cases because markets really kind of had a huge disconnect between what we're seeing in terms of the coronavirus and where the equity markets were trading. They weren't really correlated to each other. And basically, ever since New York peaked, the equity markets started to rally because New York, again, was the epicenter. And since that peak, markets have continued to rally. But one thing that I want to show everyone is the rest of the country has actually gone the opposite direction. So the number of new cases in the rest of the country have actually gone up instead of down. So this is somewhat concerning because the rest of the country is, quote unquote, starting to reopen back up. A lot of the optimism we're currently seeing in the market as a result of this, but we're actually seeing the number of deaths, the number of cases actually grow across the entire United States. It is not declining. And this is concerning to us as far as when we're projecting out everything from travel stocks, restaurant stocks that are very sensitive to when we reopen our economy, and looking at kind of that optimism and whether or not, it is the right time to start tiptoeing into some of those stocks. Based on this chart, this is telling me that it's probably not the right time because we're nowhere near where, a point where we can reopen our economies. Now, people may have differing views as far as when it's safe to go back out. And I certainly think that there's a bit of bifurcation in terms of how people feel as to whether it's time to get back out. Even here in New York, we certainly see a large number of people that have started to go out to the parks as weather has improved. So different views across the country, definitely, but the data currently still shows that this is nowhere near a peak, if you will, and we're still actually in that peaking process as far as how far this can go. I'm not here to try to speculate on that, but what this is telling me is that chances are, when we think about travel stocks, when we think about stocks that are sensitive to when things are going to reopen, there were a lot of, when we started this, most of the research was showing, we'll definitely be reopened in Q3 and Q4 will be back to normal. Right now, I think the consensus is closer to Q4 and potentially even the beginning of next year, as far as when people will feel comfortable enough to get really back out there, get back to work, get on a plane, go out and eat at a restaurant. So, the timelines are certainly shifting here, and that's exactly why we're pointing out this type of research. Now, oil. Oil has been a big factor of driving weakness here in the markets because oil is a good indicator of industrial demand and economic demand. And we started to see a bit of bottoming here in oil. So this is certainly the first step, in my opinion, of seeing some type of stability here for the markets, or at least it adds to the stability of the markets. Oil got back above $20 here on WTI front month contract. And we're seeing the same thing across crude. Energy, I think, was up about 3.5% yesterday as a result of this. So this provides some support here for the rally that we're currently seeing in the energy stocks, and we'll take a look at that sector as well. Silver is something I want to point us to because something that's been brought up a lot is the silver to gold ratio. Silver to gold is trading at something like 116 times. There's a ratio of gold to silver, and that's a historical high. Usually this type of high, or when gold and silver ratio peaks, that usually is a sign of a rally for silver, but we're not seeing that at all. And there's some reason right now as far as why gold and silver are diverging so much. And part of it is because silver is predominantly a industrial metal, meaning it's used for applications in creating electronics. So whenever consumer demand skyrockets, that's when silver tends to rally. Gold is currently being purchased as a hedge against inflation, or a hedge against the central banks around the world printing all this money to offset the COVID-19. So what we're currently seeing is that silver is giving us an indication that industrial demand is simply just not picking up. So notice how silver has not rallied along with the markets and now is starting to actually start to fall over again. So there's certainly momentum is starting to fall over, both on the weekly and daily charts. Certainly this does not look strong. And again, this speaks to the disconnect that I currently see between indicators like silver and oil for industrial demand with where the equity markets are trading. So I think in order to really understand where the equity markets, why 284, 285 is such a battleground, and why we're seeing so much whipsawing between these levels, I think the best thing to do is start taking a look at some of the sectors. And we'll start by looking at some of the strong sectors like healthcare. Healthcare remains the strongest sector. It has rallied pretty much the entire sell-off back. It came back to retest some support on the weekly chart. It came back to retest after such a strong rally from about $74 all the way to 102. And, this type of rally, you need a pause. And this is exactly what we had over the last few trading sessions. And looks like at this point, there's both support on the weekly chart as well as support on the daily chart for at least a resumption back into that 102 area. So we certainly see healthcare as one of these sectors that is likely going to continue finding support and rallying a little bit higher, especially as some of these stocks continue to position for COVID-19 cures and vaccines, and there's a lot of speculation around that. Again, in the healthcare space, I preferred looking at the IBB because as far as trying to speculate on a cure for the coronavirus, I think you want a more specific index for biotech versus just the general healthcare, because healthcare obviously includes a lot of different types of healthcare stocks. IBB is a little bit more targeted for the pharmaceutical stocks and biotechnology stocks. So my preference would be playing that through IBB. We've been talking about this for quite some time in terms of 123 being a major resistance level. As you can see here, we tested it multiple times, finally broke out above it, came back to retest it earlier, and is starting to break out again. So my indication is that I think this is going to resume back higher into that 128 level here for biotech. So healthcare, very strong. Technology, also very strong. Very similar chart. The weekly candle managed to make it back above the 20-week moving average. Same thing here on the daily chart. After that strong rally, came back to retest it. Looks like it might be continuing to move higher. And this is the bifurcation that we're currently seeing across the different sectors. So we're seeing some sectors like technology and healthcare continue to find support, continue to have the relative strength to continue to rally. The earnings for these particular stocks also came in relatively in line with analyst expectations. Many of them actually beat expectations, especially the big mega cap names. So that's why we're seeing so much strength across these types of sectors versus on the flip side you have sectors like the industrial sector that really has not seen that same type of strength, has not even managed to make it back to the 20-week moving average, and has already started to roll over here. On the daily chart, it has barely managed to get back above that daily 20-day moving average. It actually closed below it. Looks like it'll probably open up back somewhere around that channel or right around that moving average. But as you can see, momentum remains fairly weak. It's still, RSI is still, just around 50 here, 47 on the daily chart. The weekly chart, the RSI is 37. So very weak momentum across the board. And this is really the bifurcation we're seeing across sectors, where you have strong sectors like technology and healthcare, weighed by the weak sectors like industrials and perhaps real estate, which is another weak sector. And when you combine all of this together, that's when you have this market that's just kind of flip-flopping back and forth between slightly risk on, slightly risk off, and it doesn't really have a good sense of direction, and it's whipsawing people back and forth. It kind of looks like it's going to start breaking down last week, but it doesn't. It comes right back up. And then as things rally, it doesn't really go very far, and it starts to sell off again. And really, it's this battleground that we're currently seeing between the different sectors. So industrials, same thing. Industrials is one of the few sectors that after the initial rally came back to retest, and the subsequent push actually couldn't even make it back to the prior high. Weekly chart was rejected at the 20-week moving average, starting to move back lower, broke down below the 200-week moving average. So there's certainly a lot of weakness here across real estate as well, which is not surprising given that real estate would be one of the heaviest hit sectors from the lack of travel, or the lockdowns that we're having around the country. If you look at energy shares, this is where I think there is some potential here. Energy obviously was and still is the weakest sector. It still hasn't even managed to rally back up to that 20-week moving average. It has a little bit more to go to that 42 or so 20-week moving average. The daily chart seems to have found a little bit of momentum. The daily chart seems to have found a little bit of momentum, continues to make higher highs and higher lows, bounced off this 20-day moving average, bounced off the 50-day moving average. Momentum, as you can see, is confirmed these continued rallies. So I expect that energy shares are probably going to rally back into this 42.5, which is a huge gap here that's waiting to be filled, and I expect that to be filled in the next few days, which coincides here, as you can see, with that 20-week moving average, that gap that we're seeing. So energy shares, especially with oil getting back above $22, I think there's a fair amount of support here for oil or energy stocks to start moving higher. So, one of the weakest sectors that really has been a continued loser throughout this sell-off, or well before the sell-off, is now starting to come back to life. I will say that once you get to 42, this sector may roll over, especially if oil doesn't continue to rally. That's very possible that rally kind of just gets stuck around this $22, $25 level. If it does that, I would expect to see a fair amount of resistance and selling around that 42 level. So a lot of different sectors look very different. Communications starting to look fairly strong here. The weekly chart is getting right above that 20-week moving average, starting to peak a little higher here, peak higher above that 20-week moving average. The daily chart looks fairly constructive. It did move quite quickly here, and I will say that momentum is starting to slow down a little, but it looks like it's going to at least make a retest or see if it can break back above that 200-day moving average. If it breaks back above the 200-day moving average, that certainly puts us in a slightly more bullish tone here for communications. So think about Verizon, think about T-Mobile, think about Netflix. These are stocks that are actually, really starting to come to life here on some of these pullbacks. So communications, certainly one sector to pay attention to. Utilities has not been particularly strong, especially it being a very defensive sector during the sell-off, a very defensive sector during the subsequent rally, has really started to fade. And that speaks to some of the strength that we're seeing from other sectors. There's been a little bit of a lesser demand from these defensive stocks. Utilities, staples look relatively similar. Utilities was rejected at the 20-week moving average. Now trading down to the 200-week moving average. It certainly has found some support around there. But as you can see, it's not making higher highs. It's actually making lower highs and lower lows. And momentum is certainly starting to move lower here. So utilities may actually see some further weakness here. And this is the bifurcation we're currently seeing across the sectors. Staples looking very similar to utilities here as well. Rejected at the 20-week moving average, has a bit to go down to the 200-week moving average. But again, lower highs, lower lows, as opposed to the other sectors that are making higher highs and higher lows, and momentum starting to move a little lower here. So this is a kind of a key area around 57 or so for staples to see if it can hold that. If it doesn't hold that, there's quite a bit of downside here down to 55 and potentially even lower to 52 here to the downside for staples. So staples is definitely one of the sectors to take a look at. So we're clearly seeing this rotation now out of the defensive sectors from staples, from utilities into the more cyclical sectors, technology, healthcare, even discretionary, one of the stronger sectors. Discretionary really coming back to life. The only thing I will say, discretionary really got rejected at the 20-week moving average last week, but looks like it's starting to gather a little bit more strength to move higher here. Pulled back to that 20-day moving average. Looks like it's gathering some strength back into that 117, 118, 200-day moving average. Momentum isn't particularly let's see. Momentum isn't particularly strong, but certainly not very weak here. So I think discretionary may have some final strength to get into that 117, 118 area. But money flow remains relatively weak. So that tells me that generally speaking, I'm cautiously bullish here. I don't want to get too bullish, especially as it gets even a little higher. I think you're going to get waves of resistance above 116, 124 in that area. You certainly have a lot of investors that have bought stocks in this area that might be looking to get out at break even. So be very careful as these stocks continue to rally. Financials, another sector that really has lagged, one of the weakest sectors, partially because of interest rates, has not rallied nearly as much. Hasn't even touched the 20-week moving average, similar to the energy stocks, but it slowly continues to kind of grind its way higher highs, higher lows. But I think financials is going to struggle to continue moving higher, especially as interest rates remain relatively low. If you look at 10-year yields, still trading around 60 basis points. Financial stocks, they're going to have a tough time to rally. The 200-week, on the weekly chart, it still remains below some major support and resistance levels. So those are certainly key levels to keep an eye out on. You might get one small rally into that 24 and a half area, but likely you might actually see this roll over if it does get back into that area. Communications, I think we covered communications already actually. So materials also coming back a little bit to life here. Certainly was rejected last week at the 20-week moving average, but again, showing some strength again this week. The daily chart continues to make higher highs, higher lows. Momentum also confirming these rallies. So I certainly think that materials can continue to move up to this $54 level. So across the board, you have these sectors that are really moving. You're seeing a lot of sector rotation across the sectors. We're seeing strength coming back into some of the cyclical sectors and rotating out of the more defensive sectors. But I will say that, if markets start to correct lower, if we go back to SPY, 284, 285 is this battleground area. Eventually, we might see the stock start to roll over, the market start to roll over. If that happens, I do expect that rotation out of these cyclical sectors like technology, especially discretionary, back into communications, back into utilities, back into staples. But at the moment, markets are kind of in this equilibrium state. Just be aware of the fact that there's a clear bifurcation here between the weekly chart, which is still below some major resistance levels, and the daily chart, which is still continuing to battle this 280, 290 area. So that's the research that we're currently watching here for today. I hope that this was useful for you guys to start your day in terms of understanding where different sectors are, where different markets are, and also just understanding where the research currently sits with respect to the coronavirus and how industrial demand, looking at silver and oil, provides a little bit, I think, more of a real-time indication as to where industrial demand really is. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys next week.